Hi there, tax accountants. I hope all is well, and I pray that as you're viewing this video that you're in the best of health and spirit. This video will cover Chapter 6, Corporations, Redemptions, and Liquidations from Southwestern Federal Taxation, Corporations, Partnerships, Estates, and Trusts. By the end of this chapter, you should be able to identify the stock redemptions that qualify for sale or exchange treatment, determine the tax impact of stock redemptions on the distributing corporation, determine the tax consequences of Section 306 stock dispositions, determine the tax consequences of complete liquidations for both the corporation and its shareholders, determine the tax consequences of subsidiary liquidations for both the parent and the subsidiary corporations. And lastly, identify planning opportunities available to minimize the tax impacts of stock redemptions and complete liquidations. So when a shareholder sells stock to an unrelated third party, the transaction is typically treated as a sale or as an exchange. But in this case, we account for stock redemption where a shareholder sells stock back to the issuing corporation. And in such case, the transaction, it can have an effect on the dividend distribution versus it being treated as a sale or an exchange. So stock redemption occurs when a corporation acquires its stock from a shareholder in exchange for cash or other property under Section 317B. So in general, under Section 317B, stock redemption, again, this occurs whenever a corporation acquires, it buys back stock from a shareholder in exchange, again, for cash or property. So although the sale of stock to an outsider, it normally results in a sale or exchange treatment, only qualifying stock redemption is treated as a sale for tax purposes. So keep that in mind. When it relates to non-qualified stock redemptions, these are denied the sale or exchange treatment because they are deemed to have the same effect as dividend distributions. So stock redemptions occur for a variety of reasons. Publicly traded corporations, they often reacquire, buy back their shares in order to increase shareholder value. For corporations where the stock is closely held, redemptions, they often occur to achieve shareholder objectives. For instance, let's say for a closely held corporation, they might use the redemption to acquire the stock of a deceased shareholder, using the corporate funds to purchase the stock from the decedent's estate. That means that the remaining shareholders, they don't need to use their own money in order to acquire the stock. Stock redemptions, they might also occur as a result of a property settlement when a divorce occurs and when spouses jointly own a controlling stock interest in a corporation. The divorce decree, it might require that the interest of one spouse be bought out, and a redemption helps to settle that essentially without having to use the other spouse's personal assets. Stock redemptions, they might also be used to frequently incorporate into buy and sell agreements before shareholders, and this allows the corporation to redeem, to buy back the stock of the shareholder who wants to end their ownership in the corporation. So again, stock redemptions, they can take place for a variety of reasons. So if the transaction has the appearance of a dividend, then the redemption will not be qualified. So for example, if a shareholder owns 100% and the corporation buys 1/2 of the stock for X dollars, the shareholder basically still owns 100%. In certain kinds of stock redemptions, they are allowed the sale or exchange treatment. So non-corporate shareholders, they generally prefer to have stock redemption treated as a sale or an exchange rather than a dividend distribution. So in the case that there's a disposition of stock and a complete liquidation of a corporation, this generally produces the sale or exchange treatment to the shareholder. So when there's a redemption and it's not qualified, the shareholder has to report dividend income. And individual shareholders, if it is qualifying dividends, then they may be taxed at 0. 15 or 20%. Qualifying dividends are taxed similar to long-term capital gains. They receive preferential tax treatment. But if it doesn't qualify as a redemption, the redemption proceeds cannot offset the basis in the stock surrendered, and it cannot be offset by capital losses. So in such case, corporate shareholders may prefer the dividend treatment because they are allowed to take the dividends received deduction. So there's the following types of distributions that may be treated as a redemption of stock rather than as a dividend. So under prior law, the dividend equivalency rules used to determine which stock actually qualifies for sale or exchange treatment. And under that rule, depending on the facts and the circumstances of the redemption, that essentially determined whether or not the redemption was equivalent to a dividend. The dividend redemption did not qualify for sale exchange treatment, and instead, the amount received by the shareholder was taxed as dividend income to the extent of the corporation's EMP. But obviously, there was some uncertainty and subjectivity surrounded that rule, which led Congress to enact several objective tests in order to determine the status of a redemption. So the following types of distributions may be treated as stock redemption rather than a dividend. So distributions that are not necessarily equivalent to a dividend, that's the subjective test. A disproportionate distribution in terms of the shareholder effect. Distributions in termination of a shareholder's interest. Partial liquidation of a corporation where the shareholder is not a corporation and either the distribution is not essentially equivalent to a dividend or an active business is terminated. Or distributions to pay death taxes, where the redemption is limited to the sum of death taxes and funeral and administrative expenses. So these are the 5 types of stock redemptions that qualify for sale or exchange treatment. So as it relates to stock attribution rules, so as explained earlier, in order to qualify for the sale or exchange treatment, the stock redemption generally it has to result in a reduction of the shareholder's ownership interest in the corporation. So in order to determine whether the stock redemption has sufficiently achieved that, has sufficiently reduced the shareholder's interest, the stock owned by the related party is attributed to the redeeming shareholder. So Congress enacted the stock attribution rules to serve this purpose ultimately. So under these rules, related parties, they're defined to include the following family members. It can include spouses, children, grandchildren, parents. And attribution also takes place from and to partnerships, estates, and trusts, whereby there's 50% or more ownership required in the case of C corporations. So these are the rules for family. If it's deemed or constructive ownership, an individual is deemed to own the stock owned by his or her spouse, children, grandchildren, and parents, not siblings or grandparents as mentioned. A partner is deemed to own the stock owned by a partnership to the extent of the partner's proportionate interest in a partnership. Stock owned by a partner is deemed to be owned in full by a partnership. Next, we move on to the estate or trust. For an estate or trust, the beneficiary or an heir is deemed to own the stock owned by an estate or a trust to the extent of the beneficiary or heir's proportionate interest in the estate or trust. Stock owned by a beneficiary or an heir is deemed to be owned in full by an estate or a trust. As it relates to a corporation, stock owned by a regular corporation, and when they say regular corporation, that's referring to a C corporation because S corporations are treated differently. So stock owned by a regular corporation is deemed to be owned proportionately by any shareholder owning 50% or more of the corporation's stock. Stock owned by a shareholder who owns 50% or more of a regular corporation is deemed to be owned in full by the corporation. So family attribution rules, these can be waived in some complete termination redemptions. And in addition, the stock attribution rules, they don't apply to partial liquidations or redemptions to pay death taxes. So just keep that in mind. And whenever redemption fails to satisfy any of the qualifying stock redemption rules, the basis of the redeemed shares, it does not disappear. So typically what happens, the basis would be attached to the basis of the redeeming shares that remain in the corporation. But if, however, the redeeming shares were terminated, or has terminated rather, the direct stock ownership, and the redemption is non-qualified due to the attribution rules, in such case, the basis of the redeemed shares, it will attach to the basis of the constructively owned stock. So in this manner, when there's a non-qualified stock redemption, it can still result in stock basis being shifted from one taxpayer to another taxpayer. So we have what's called not essentially equivalent redemption, and this is governed by Section 302B1. So when a redemption qualifies for sale or exchange treatment, if not essentially equivalent to a dividend. So we mentioned there's a subjective test. So this is a continuation of the dividend equivalency rule. And this was retained principally for redemption of preferred stock, because preferred shareholder, they often have no control over when the corporation redeems preferred stock. They don't have any say so, essentially. And this also applies to common stock redemptions. So in order to qualify the redemption, it must result in a meaningful reduction in the shareholders' interest in the redeeming corporation. So this was based upon the US's Supreme Court decision in US versus Davis. In such case, a redemption will qualify as a not essentially equivalent redemption only when, again, the shareholders' interest in the redeeming corporation has been meaningfully reduced. So there's a test, the meaningful reduction test. And with this test, the stock attribution rules, again, they apply. A decrease in the redeeming shareholders' voting control appears to be the most significant indicator of a meaningful reduction, but reduction in the rights of the shareholders to shares in the corporate earnings or to receive corporate assets in liquidation, those are also considered. Next, we have disproportionate redemptions. So a stock redemption qualifies for sale or exchange treatment under Section 30B2 as a disproportionate redemption if both the following conditions are met. After the distribution, the shareholder owns less than 80% of the interest owned in a corporation before the redemption. After the distribution, the shareholder owns less than 50% of the total combined voting power in all classes of stock that's entitled to vote. So in determining the shareholder's ownership interest before and after redemption, the attribution rules apply as well. So here we have this example. Shareholder has 60% ownership of the corporation. They have 60% ownership represented by 60 shares of the total 100 outstanding voting shares. In the redemption, the shareholder transfers 25 voting shares to the corporation, and the corporation pays cash and property to the shareholder for 25 voting shares. So in this case, the shareholder has 46 2/3% ownership represented by 35 voting shares. How do we determine that? He originally owned 60 shares, transferred 25 shares in the redemption. So 60 minus 25 leaves 35 voting shares of 75 remaining outstanding shares. Originally, there were 100 shares outstanding. 25 shares were reacquired, redeemed, purchased back. So therefore, there's 75 outstanding voting shares. So based on this, the redemption is qualified disproportionate redemption because the shareholder owns less than 80% of the owned prior redemption. 80% times 60% equals 48%. and the shareholder owns less than 50% of the total combined voting power of the corporation. Next, we have complete termination redemptions. So a redemption that terminates a shareholder's entire stock ownership in a corporation qualifies for sale or exchange treatment under Section 302(b)(3). The attribution rules, they generally apply in determining whether the shareholder's stock ownership has been completely terminated. However, the family attribution rules, they don't apply to a complete termination or redemption if both of the following conditions are met. The former shareholder doesn't hold or acquire any interest other than that of a creditor in the corporation for at least 10 years after the redemption. This includes an interest as an officer, a director, or an employee, and this is called prohibited interest. In addition, the second rule is that the former shareholder files a statement agreeing to notify the IRS within 30 days if a prohibited interest is acquired in the 10-year post-redemption period, and they retain all records related to the redemption during this time period. So let's say this acquisition of stock in the corporation by bequest or inheritance, that's not considered prohibited interest. The required statement, but it must be signed by the former shareholder and attached to the tax return for the year in which the redemption occurs. So as we can see, when there's complete termination, then there are some nuances, there are some rules behind that type of a redemption. As it relates to partial liquidations, this is governed by Section 302(b)(4). So when a non-corporate shareholder receives sale or exchange treatment for a distribution that qualifies as a partial liquidation. A partial liquidation, this is a distribution that's not essentially equivalent to a dividend. And two, it's both pursuant to a plan and made within the plan year or within the succeeding taxable year. In a stock redemption that's pursuant to a partial liquidation, it may be pro rata with respect to the shareholders. And in such case of a pro rata, if there's an actual surrender of stock, it's not required to qualify the transaction as a partial liquidation. So there's a test for not being essentially equivalent, and it looks at the effect on the corporation. So in such case, it requires genuine contraction of the business of the corporation. And it essentially, this concept rather can be difficult to prove due to the lack of objective tests. So in light of that, the IRS, they have ruled that neither the sale of investments nor the sale of excess inventory will satisfy the genuine contraction test. So this test is subjective. Therefore, taxpayers, they'll seek a favorable ruling from the IRS before they decide to proceed. Again, because it's difficult to apply, because it is subjective rather than being objective. Under these safe harbor rules, there's a termination of business test that satisfies the not essentially equivalent to a dividend requirement, and a distribution in such case will qualify under the termination of a business test if all of the following conditions have been met. If the corporation has two or more qualified trade or businesses, a qualified trade or business is any trade or business that is actively conducted for the 5-year period ending on the date of the distribution, and two, was not acquired in a taxable transaction during that 5-year period. Second, the distribution consists of the assets of a qualified trade or business or the proceeds from the sale of such assets. Thirdly, the corporation is actively engaged in the conduct of a qualified trade or business immediately after the distribution. Under the same code, Section 303, it also provides sale or exchange treatment to a redemption of stock that's included in and representing a substantial part of a decedent's gross estate. So this is redemptions to pay death taxes. This provision provides an estate with liquidity, right? So what does liquidity mean? Liquidity is essentially how fast you can turn assets into cash. Why? Because again, you need to pay the death-related expenses when a significant portion of the estate consists of stock in a closely held corporation. So there's some special treatment limited to the sum of death taxes, as well as the funeral and administrative expenses. And the redemption price is the same as the estate's basis in the stock. So redemption to pay death taxes result in no gain or loss to the estate. In Code Section 303 applies only to a distribution that's made with respect to stock of a corporation that's included in the gross estate of a decedent and whose value exceeds 35% of the value of the adjusted gross estate. So whenever there's stock redemptions, we essentially, focus not just on the effects for the shareholder, but also what is going to be the impact on a corporation. So there's several considerations, several things that the corporation needs to consider as it relates to tax purposes. The recognition of gain or loss on a property that's distributed after redemption. What's the effect of the qualifying stock redemption on a corporation's earnings and profits? Are the expenditures deductible in connection with the redemption? So these are some things that need to be considered. So first and foremost, the recognition of gain or loss. Distributions in the redemption of stock, qualifying or not, they're considered non-liquidating distributions. So under Section 311, corporations, they recognize gain on all non-liquidating distributions of appreciated property. And again, appreciated property is where the fair market value of property exceeds the basis. So the corporation purchased the property for $100,000, and now the fair market value of that property is $150,000 versus depreciated property where the corporation purchased the property for $100,000 and now it is worth $80,000. That is depreciated property. So just keep in mind, they recognize gain on all non-liquidating distributions of appreciated property, as if the property had been sold for its fair market value. And when the distributed property, if it's subjected to a corporate liability, and if the liability is greater than the property's fair market value, the liability amount is used to determine the gain. As it relates to losses, unfortunately, losses are not recognized on non-liquidating distributions of property. So therefore, a corporation, they should avoid distributing lost property. And again, this is when the fair market value is less than the basis. What a corporation can do, they can decide to sell the property in a taxable transaction, recognize the loss, and then distribute the proceeds. So again, this presents a great opportunity for tax planning when there is stock redemption for a corporation. Next, we have to consider the effect on earnings and profits. So in a qualifying stock redemption, the earnings and profits of the distributing corporation is reduced by no more than the percentage of the corporation's stock redeemed. Corporate expenditures incurred in the stock redemption, they are unfortunately not deductible. So for example, accounting fees, brokerage fees, legal fees, loan fees. So in redeeming the shares, obviously they'll incur certain expenses, but under Section Code 162K, it specifically denies deductions for expenditures incurred in connection with a stock redemption. In this allowance, it doesn't apply to any amounts otherwise deductible as interest under Section 163. So if there's interest from debt finance redemptions, those are considered deductible. When there's a covered corporation, there's an excise tax. So for any covered corporation, the Inflation Reduction Act of 2022 includes a 1% excise tax that applies to the fair market value of the stock repurchases, the redemptions, after December 31st, 2022. And in addition, the amount of repurchase that's subject to tax is reduced by the value of any stock that's issued during the year. And this also includes the value of any stock issued or provided to employees or of the corporation during the tax year. So there's some stock repurchases that are not subjected to taxes. And this is where the total value of the stock repurchased during the year doesn't exceed 1 million, where the repurchase is part of a reorganization and there's no gain or loss recognized on the repurchase by a shareholder by reason of the reorganization. And lastly, where the stock repurchase is contributed to an employer-sponsored retirement plan, aka the ESOP, or there's an employee stock ownership plan or some type of similar plan. Next, we look at stock redemptions and preferred stock bailouts. So stock redemptions that don't fall within any of the qualifying stock redemption provisions, they're treated as dividend distributions to the extent of the corporation's EMP. So in order to obtain sale or exchange treatment, taxpayers, they devise ways to circumvent these redemption provisions. So the preferred stock bailout was one of these types of transactions that was devised in an attempt to basically get the benefit of a qualifying stock redemption without the advantages associated with it. So typically a preferred stock bailout, this is when a corporation issues a non-taxable, non-voting preferred stock dividend on common stock, and the shareholder assigns a portion of their basis in the common stock to the preferred stock. And in such case, the preferred stock is sold to a third party. So because in such case, the disposition doesn't take the form of a stock redemption, then there's some related limitations on the sale or exchange treatment that don't necessarily apply. So obviously, the sale of the preferred stock is going to be treated like any other capital asset disposition, where the proceeds are going to be offset by the basis. And again, this is unlike the sale of common shares because the sale of the preferred stock doesn't reduce the shareholders' ownership interest in the corporation. So in order to minimize the abuse potential, the code requires the following treatment. So the tax avoidance possibilities of this preferred stock bailout, as we just described, obviously, there was abuse taking place. Therefore, Section 306 of the Internal Revenue Code was enacted. And in a sale of Section 306 stock to a third party, the shareholder generally has ordinary income on the sale equal to the fair market value of the preferred stock on the date of the stock dividend. And the ordinary income is treated as a dividend for purposes of the preferential tax rate on dividend income. So keep that in mind, but it has no effect on the issuing corporation's earnings and profit. There's no loss that's recognized on the sale of the preferred stock, but instead, any unrecovered basis in the preferred stock, it's sold and added to the basis of the shareholder's common stock. But if instead the sale to a third party issuing corporation redeems the preferred stock from the shareholder, then in such case, the redemption proceeds constitutes dividend income to the extent of the corporation's EMP. So again, there's no loss recognized on the sale of tainted preferred stock. And if it's redeemed by the corporation, the proceeds are treated as a dividend to the extent of the EMP. In Section 306, stock is stock which is not common stock. It's received as a non-taxable stock dividend. It's received tax-free in a corporate reorganization plus other requirements, or has a basis determined by reference to 306 stock. And if a corporation has no earnings and profits on the date of distribution of a non-taxable preferred stock, then unfortunately the stock will not be considered 306 stock. Next, we consider liquidations in general. So when we consider liquidations, we need to determine, all right, well, what's the tax consequences of a complete liquidation for both the corporation as well as the shareholders? So whenever a corporation makes a non-liquidating distribution, for example, stock redemptions, as we're learning about, the entity continues as a going concern. But when there's a complete liquidation, however, the corporation, the existence of the corporation altogether, it terminates. So since the corporation terminates, so does the shareholders' ownership interest. So a complete liquidation, like a qualifying stock redemption, this produces ultimately a sale or exchange treatment to the shareholder. However, the tax effects of a liquidation to the corporation, it varies somewhat from those of redemption. So the sale or exchange treatment is the general rule for a liquidating corporation. However, some losses, unfortunately, are disallowed. So again, when the corporation winds up their affairs, they pay debts, they distribute the remaining assets to the shareholders. This produces sale or exchange treatment to the shareholder, and the liquidating corporation recognizes gains and losses upon distributions of its assets with certain exceptions. So there's a process for liquidation. With a corporate liquidation, this occurs when the corporation ceases, it stops from being a going concern. Essentially, what this basically means, the business closes its doors. And the corporation, as we mentioned, they wind up affairs, pay debts, distribute any remaining assets to the shareholders. So when there's a complete corporate liquidation, a legal dissolution under the state law is not required. So keep that in mind. It's not required to, have a legal dissolution. So further, the corporation, they can retain a nominal amount of assets to pay any remaining debts and or preserve its legal status and liquidate for tax purposes. So obviously, there's a lot of nuance around that, but that's very important to keep in mind. So again, the corporation, they can liquidate, but they can retain a nominal amount of assets and preserve their legal structure. So shareholders might decide to liquidate for one or more reasons. Maybe the corporate business has been unsuccessful. The shareholders want to acquire the corporation's assets, or another person or entity, they want to purchase the corporation's assets. In such case, the purchaser, they can buy the shareholder's stock, liquidate the corporation to acquire the assets, and alternatively, maybe the purchaser, they want to buy the assets directly from the corporation, and then after the assets are sold, the corporation then distributes the proceeds to its shareholders and liquidates. So there's different means used to liquidate a corporation. Obviously, depending on the situation, there's varying tax results and impacts to the shareholder as well as to the corporation. So as noted previously, with the non-liquidating distribution of non-cash property, it produces gains, but not losses, recognized to the distributing corporation. For the shareholder, the receipt of cash or other property produces dividend income to the extent of the corporation's earnings and profits, or in the case of a qualifying stock redemption, it results in a sale or exchange treatment. So much like a qualifying stock redemption, when there's a liquidation that produces sale or exchange treatment for the shareholders, earnings and profits has no impact on the gain or loss recognized. However, whenever there's a liquidation, a corporation generally recognizes gain and loss on any assets that are being distributed. So in the event that, let's say, a corporate distribution results in a loss to the shareholder, there's another distinction that needs to be considered between non-liquidating distributions and liquidations. And this is governed by Section 267A, and this disallows the recognition of losses between related parties in a non-liquidating distribution, but not in liquidating distributions. And as it relates to liquidations and the effect on distributing corporations. So a corporation generally is going to recognize gain or loss on the distribution of property in a complete liquidation. However, there are several exceptions to the rule. So under Section 336A, a corporation recognizes gain or loss on the distribution of property in a complete liquidation as if the property were sold at its fair market value. So, this treatment is basically consistent with the notion of double taxation that's inherent with operating a business as a C corporation. Because again, they're going to pay taxes at the corporate level, and then they're going to pay taxes again at the shareholder level. So in the extent that there's a non-liquidating distribution, if the distributed property is subjected to a corporate liability that's greater than the fair market value of the property, the liability amount is going to be used to calculate the gain or loss. And any liquidating expenses incurred by the corporation, that are deductible as a trade or business under Section 162. So, for example, accounting, legal costs, the cost of revoking the charter, and things of that nature. And any expenses related to the sale of property, brokerage commissions, legal costs, that reduces the amount really realized on the sale. Then we have what's called anti-stuffing rules. For the transferee corporation, they take a basis in the property that's equal to that of the transfer shareholder. So what this basically means with these anti-stuffing rules, whenever property is transferred to a corporation in a Section 351 transaction or as a contribution to capital, the carry over basis rules apply. So as we know with Section 351, there are 3 rules. The first thing is that there must be a transfer to a corporation of property in exchange for stock, and the shareholders must be in control of the corporation, and that control is 80%. So that's that Section 351 rule. So usually the transferee corporation, they'll take the basis in the property that's equal to that of the transferor shareholder, and then the shareholder will take a basis in the stock equal to the stock that was received in exchange. But there are some limitations. So with these anti-stuffing rules, Congress basically, they want to avoid a duplication of loss. So there's 2 loss limitations, these anti-stuffing rules, which is governed by Section 336D. And this applies to corporations on liquidation when there's lost property that's distributed to related properties, and certain lost property that's distributed or sold that had been contributed with an already built-in loss. So these anti-stuffing rules, the transferee corporations takes a basis in the property equal to that of the transferor shareholder. It's required when a shareholder transfers property having an aggregate basis in excess of their aggregate fair market value. And the transferor shareholder, they can elect to reduce their stock basis by the amount of the net built-in loss. And limitations on losses for related party transactions. Losses are disallowed on liquidating distributions to related parties in either of the following cases. If the distribution is not pro rata, so in pro rata distributions, each shareholder receives their share of each assets, or when the property is distributed is disqualifying property. So disqualifying property is property that's acquired by a corporation in Section 351 transaction during the 5-year period ending on the date of the distribution. And as it relates to limitations on losses for built-in loss situations, losses are disallowed when property distributed was acquired in a Section 351 transaction, and the principal purpose was to recognize loss by the corporation on the liquidation. And if the purpose is presumed, if the transfer occurs within 2 years of adopting the liquidation plan. So again, to avoid any abuse, that is why 366 was enacted to ensure that this disallowance rule, it applies to the extent that the built-in loss is not eliminated with the step-down basis. Again, want to make sure that the tax law and the losses as it relates to these liquidating distributions are not being taken advantage of. So here we see the distributions of lost property and liquidation. We have a flow chart. So is the liquidating corporation distributing lost property? If the answer was the pro rata, or the next question rather is, was the distribution non-pro rata to a related party? If their answer is yes, then the loss is disallowed. If the answer is no, it was not to a related party, the next question is, was the distributed property disqualified property? And this is property acquired by the liquidating corporation in a Section 351 transfer or as a contribution. If the answer is yes, Was it to a related party? If the answer is yes, then the loss is disallowed. If the answer is no, then the loss is allowed. And in such case, you have to consider, was the principal purpose in transferring the property simply to recognize the loss? So there's a lot of nuance, a lot of questions. Again, this is great tax planning opportunities before corporations make these decisions to completely liquidate. You want to be able to fully understand the tax implications for both the corporation as well as the shareholder. So liquidation effects on the shareholder. So the tax consequences to the shareholder of a corporation in the process of liquidation is generally governed by Section 331. And there's an exception to this rule, Section 332, and this applies if there's, liquidation of a subsidiary. So generally, the gain or loss that's recognized on a receipt of property from a liquidating corporation, the amount is equal to the fair market value of the property received minus the adjusted basis in stock, and is generally treated as a capital gain or a capital loss. And the basis in the assets received in the liquidating distribution, it's equal to the fair market value on the date of distribution. There's some special rules when there are installment obligations. The shareholder may decide to defer gain recognition to the point of collection, and the corporation must recognize all gain on the distribution. As it relates to liquidations when there's a parent-subsidiary situation. So there's an exception to the general rule of Section 331 and 332, and this provides that a parent corporation does not recognize gain or loss on a liquidation of a subsidiary. In addition, the subsidiary corporation would recognize neither a gain nor a loss upon liquidating distributions of a property to its parent. And there's 3 requirements for applying Section 332. And in order to qualify, the parent must own at least 80% of the voting stock and value of the subsidiary stock. The subsidiary must distribute all property in complete cancellation of all its stock within the taxable year or within 3 years from the close of tax year in which the first distribution occurred. In addition, the subsidiary must be solvent. So if these requirements are met, non-recognition of gains or losses, it's mandatory. However, if the subsidiary is insolvent, then the parent corporation, they're going to have an ordinary loss deduction under Section 165, and it's going to be equal to the basis in the subsidiary stock. And let's say in the event that the liquidation involves several distributions, then the 80% test needs to be met on the date of the plan of liquidation, that it's adopted and maintained until the final distribution is received by the parent. And let's say that the parent fails this 80% test at any time, then in such case, the provisions for the non-recognition of gain or loss, it's not going to apply. So again, once a corporation owns more than 80% in another corporation, they are considered a parent corporation, and then the corporation that they own is considered a subsidiary. Next, we considered minority shareholder interests. So in Section 332, parent subsidiary liquidations up to 20% of the subsidiary stock can be owned by minority shareholders. So in liquidations of such cases, the distribution of property to a minority shareholder is treated in the same manner as a non-liquidating distribution. So that is, the subsidiary corporation recognizes gain, but not losses on the distributed property to the minority shareholder. So again, the subsidiary corporation, it's treated in the same way as a non-liquidating distribution. The distributing corporation recognizes the gain, but not a loss. Minority shareholders recognize gain or loss, and the amount is equal to the fair market value of the property received minus the basis in stock. If there's indebtedness of subsidiary to the parent, so if a subsidiary transfers appreciated property, and we know appreciated property is where the basis, the cost paid for the property plus any improvements, is less than the fair market value. So again, a quick example, corporation paid $100,000 for a building and now it's worth $150,000. That is appreciated property. And in such case, if a subsidiary transfers appreciated property to satisfy a debt, it has to recognize gain on the transaction unless the subsidiary is liquidating and the conditions of Section 332 apply. So when Section 332 applies, the subsidiary does not recognize gain or loss upon the transfer of property to the parent in satisfaction of indebtedness. Keep in mind, this non-recognition provision, it doesn't apply to the parent corporation. The parent corporation is going to have to recognize the gain or loss on the receipt of the property in satisfaction of the indebtedness, even if the property is received during the liquidation of the subsidiary. As it relates to basis of property received by the parent corporation, the general rule is as follows. Any property received by the parent corporation in a complete liquidation of a subsidiary, it has the same basis that it had in the hands of the subsidiary. This is unless the parent corporation elects to make a Section 338 election. And this carryover basis in the assets, generally it'll differ from the parent's basis in the stock of the subsidiary. So because such type of liquidation, it's non-taxable, the parent's gain or loss on the difference in the basis is not going to be recognized. So furthermore, the parent's basis in the stock of the subsidiary, it is going to disappear. When the parent acquires tax attributes of the subsidiary, so for example, when dealing with NOLs, business credit, carryovers, capital losses, EMP, etc. And unfortunately, this may result in some iniquities. Next, we consider this Section 338 election. So as we just discussed, the liquidation of a subsidiary generally is considered a non-taxable transaction, and that results in the non-recognition of gain or loss for both the parent as well as the subsidiary corporation and the carryover of the subsidiary's asset bases and the other tax attributes. So this treatment, it reflects the fact that such a liquidation is awfully merely just a change in corporate structure. It's not necessarily a change in substance. So this is generally the case when, let's say, the parent owned the stock of the subsidiary since the inception. And in these cases, the carryover bases are comparable to what the parent would have if it and the subsidiary had not originally acquired the assets. So in such case, the parent, they may elect to treat an acquisition of stock in an acquired corporation as a purchase of the acquired corporation's assets if the election is made by the 15th day of the 9th month, beginning after the month in which a qualified stock purchase occurs. Qualified stock purchase occurs when a corporation acquires stock representing at least 80% of the voting power and a value within a 12-month period. It must be acquired in a taxable transaction. So essentially the stock purchases by affiliated group members, those count. The tax consequences, obviously, this is one of the most important things to consider. So if Section 338 is elected, the subsidiary is treated as having sold its assets on the qualified stock purchase date for the value that is determined with reference to the parent's basis in the subsidiary stock, plus any liabilities of the subsidiary. And again, if the subsidiary is liquidated, the parent will obtain a carryover of the stepped up or stepped down basis of the subsidiary assets. And the subsidiary is deemed again to have sold its assets for an amount determined with reference to the parent's basis in the subsidiary stock, adjusted for the liabilities of the subsidiary. And lastly, as it relates to the tax consequences, the gain or loss, it is recognized by the subsidiary, and the subsidiary is treated as a new corporation that purchased all its assets on the day after the qualified stock purchase date. So there's a lot to consider as it relates to corporations, redemptions, and liquidations. So the qualifying stock redemption rules, they provide unique tax-saving opportunities for shareholders of family-owned and other closely held corporations. In addition, corporate liquidations with proper tax planning, the tax consequences can be minimized. So it's very important, again, for corporations before they make these decisions, whether it is a regular C corporation or shareholders of a family-owned or closely held corporation, they want to ensure that there's adequate, proper tax planning that takes place in light of the potential tax consequences to both the shareholder and the corporation. So now that the lesson has ended, you should have learned how to identify the stock redemptions that qualify for sale or exchange treatment, determine the tax impact of stock redemptions on the distributing corporation, determine the tax consequences of Section 306 stock dispositions, determine the tax consequences of complete liquidations for both the corporation and its shareholders, determine the tax consequences of subsidiary liquidations for both the parent and the subsidiary corporations, and lastly, identify planning opportunities available to minimize the tax impacts of stock redemption and complete liquidations.